The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
When the world's largest retailer in the world's largest economy tells you to temper expectations, you better listen. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlet Food. That sounded ominous.
I know.
We're kicking off to the closing bell here in the U.S. For the second straight day, stocks open lower, but it's not clear whether we're going to follow yesterday's path and rally into the close and finish at a new high like we did yesterday. Right now, the S&P lower by 0.5%. Walmart's latest earnings not helping. Treasuries are higher, pushing yields lower. The 10-year currently just below 4.5%. The yen is a big mover, the biggest mover in FX, climbing against all the major currencies on growing speculation that the Bank of Japan will hike rates sooner rather than later. And gold futures at a record high, up by 0.6%. It did take a stumble earlier after Treasury Secretary Scott Bessent played down talk that the U.S. government might revalue its gold holdings.
And speaking of Scott Bessent, go back to the second line on that screen here. A two-day rally right now in benchmark Treasuries, pushing yields lower with the biggest moves today in the wake of U.S. Treasury Secretary Scott Bessent's comments right here on Bloomberg Television, saying that the government won't be in any hurry to auction more longer duration securities, particularly at a time when the Fed is still reducing its balance sheet.
That's a long way off. And we're going to see what the market wants. The Fed said that they may stop their balance sheet runoff. So, easier for me to extend duration when I'm not competing with another big seller. It's going to be path dependent.
And Bessent's comments also put downward pressure on the dollar. And remember, the bullish dollar trade really did go hand in hand with the wagers on a steeper yield curve. Bessent keeping bond sales steady, combine that with the Trump administration's vows to cut government spending, and that's pretty much now kneecapped that trade. Strategies to sell the 2-year and buy the 10-year steepen that curve by more than 30 basis points in the 2 months following the November election. But since then, that curve is flattened by at least 20 basis points. Not helping matters is the latest Conference Board measure of leading economic indicators, which fell in January, 0.3%. And that data came just 3 hours after Walmart forecast lower than expected profit. Disappointing earnings and/or forecasts out of Carvana, Freshpet, Birkenstock, Wayfair, also raising questions about the health of the consumer and the health of the economy. And maybe that's a partial explanation, Scarlett, for why we're seeing stocks get sold and bonds get bought.
Yeah, maybe they're getting bought. But today it's kind of a little bit of a big mixed picture here, because while Trump is vocal about wanting lower rates, Scott Bessent has clarified that the administration is mostly focused on the 10-year yield. And right now you look at the 10-year yield and it's pretty much hugging the 4.5% level. Yes, it's fallen to as low as 3.6% in September, and then 4 months later shot up to 4.8% as investors try to reconcile optimism of a Fed cutting cycle with the prospect of Trump tariffs and tax cuts renewing inflation and extinguishing potential rate cuts. So since Trump's inauguration, uncertainty has kept that 10-year yield stuck between 4.4 and 4.6%. Romaine.
Let's bring Kathy Jones into this conversation to kick us off to the close here on this Thursday afternoon. Chief fixed income strategist with the Schwab Center for Financial Research. And you've seen just how tight the trading range has been on those treasuries, Kathy. Is there anything, in your opinion, that would break it out of that range anytime soon?
Well, either have to be a breakout to the upside because inflation has picked up, perhaps as a result of tariffs or some other sort of stimulus that we're getting on the fiscal side, or it's going to break out on the downside because the economy slows down. Tariffs eventually are a drag on economic growth, as is immigration policy. So we're just sort of stuck here waiting to see which comes first, the inflation or the growth slowdown. We're expecting both, but it's the sequencing that's still up in the air.
I am curious, though. I mean, in that interview with Bessent, he, of course, touted this idea that yields have been coming down. I think he said something like 6 straight weeks, which I think is true, at least on the 10-year. Now, what that's attributable to is certainly in debate. But he kind of implied this idea that he thinks that trend could continue largely because of some of the policies coming out of Washington. Is that realistic?
Well, I would say it's a very optimistic way of looking at things. Keep in mind, as Scarlett just pointed out, those yields went skyrocketing, after the election, and really from late September when we got revisions to the growth and employment figures. Those numbers went up, and we saw yields follow. And after the election, they really shot up, and then they've been drifting down since then. So I don't think that the mix of policies that we're hearing about suggests we're going to see great amount of disinflation, because tariffs are at least a one-time price increase. They do, if we get counter tariffs, lower growth down the road. But initially, if we get those, we're going to see prices move up. And then immigration policy, if you take a big chunk of workers out of the workforce, you both have the potential for raising both prices and wages, but also slowing growth, because workers and their output contribute to GDP growth. So the mix of policies doesn't really sound to me like we're going to get this great disinflation. Of course, we have the prospect, too, of spending cuts, but we also have the prospect of tax cuts. So I'm not sure where we're going to find all those things reconciling, but for now, it makes us very cautious.
All right. I'm so glad that you brought up immigration as well, because as we watch for either a growth slowdown or inflation, when I think about labor market metrics that will be popping up, how quickly do you think those data points will help answer that question of which one will come first, the growth slowdown or inflation picking up?
Yeah, I think it'll take a couple of months. The numbers that we're seeing on the labor market are showing some cracks in this very solid labor market that we've had for a couple of years now. Hiring has slowed down, but layoffs are not up. So we're kind of in this quiet period. Wages, though, are ticking higher, even though jobless claims and continuing claims are rising. So it seems like there's some softness under the surface there, but I think it will take a couple of months to see the impact of some of these federal layoffs and the impact of immigration changes. And I don't think we'll know that until probably in the second quarter or so.
So as Schwab's chief fixed income strategist, where do you want to be on the yield curve?
Well, we've been fairly cautious since last fall, and the reason is yields got very low. They got to our target under 380 on the 10 years. We thought, we really wanted to pull in duration at that stage of the game, and then subsequent, we've seen these policy changes that could prove to be somewhat inflationary. So we've been cautious in suggesting keeping duration at your benchmark or somewhat lower. And we're just waiting to see how things play out before committing, because the yield curve is now fairly flat, so you don't get a huge amount of pickup by going further in duration than, say, where the ag is at around 6 years or so. And then we also want to stay up in credit quality, because you're not getting paid a lot extra to take you go down in credit quality. Those spreads are really tight. So we're just kind of hanging in there, trying to stay up in credit quality to, again, wait to see what the impact of all this is going to be on the economic outlook.
I am curious, though, Kathy, as to when you anticipate that we will get a better and more definitive look of the impact. Of course, the Fed members have been peppered with questions about this, and I know publicly they don't want to sort of front run anything. But at some point, they've got to sort of have their finger on the button, sort of looking for certain economic data points that when you string together gives them that picture. Do you have any idea what that could be?
Well, I think it's going to be a combination of a slowdown in nominal GDP growth. We've been running roughly 5.5% for quite some time. It's dipped a little bit now below 5%. If that nominal growth rate were to decline into the second and possibly third quarter, then I think they'd have some evidence the economy is really slowing down and policy would be too tight. Similarly, if you see the unemployment rate really start to tick up here and the sort of the underlying data suggests that there's real softness there and more slack in the labor market, then the Fed would be inclined to move forward. And then you've got to look at the inflation data. And that, again, it's going to take a while. We've been stuck at 2.5% to 3% now for quite some time. There's nothing really in the indicators that says it's going to come down anytime soon towards 2%. So I think that that's going to be the last factor to kick in. But it'd probably be first nominal GDP GDP growth, and the second, the labor market, and third, the inflation data.
All right, Kathy, I have to leave it there. Kathy Jones, Chief Fixed Income Strategist with Schwab Center for Financial Research, kicking us off to the close here on this Thursday afternoon. A focus on the consumer and a focus on the companies that serve them. Nerdwallet shares tanking after their quarterly results showed average monthly users dropping 20% from the year prior. A conversation with the CEO, Chen, coming up in just a second.
Plus, top business leaders are gathering in Miami right now for FII, so we head there as well to speak with Barry Sternlicht. The Starwood CEO will share his investing outlook.
And a focus on travel. A look at the biggest travel trends this year with Brian Kelly, the founder of The Point Sky. All that and more coming up in a bit right here on The Close. This is Bloomberg.
Let's take a look at shares of Nerdwallet, which are slumping right now, down about 19%, almost 20%, in fact. The financial services company's fourth quarter results beat analyst estimates, and it did impress the street with its revenue forecast for this quarter. But monthly active users were down 20% from a year ago. Joining us now for more on the company and its prospects is Nerdwallet CEO Chen. Tim, welcome to the close. What do you attribute the drop in users to? And I guess the question is, how do you plan to return that to growth?
Yeah, thanks for having me. Glad to be here. On the users, we're facing some headwinds in organic search. So we talked about that on our call. We're really hoping to lap those things going into 26 and continue to grow from there. And internally, our focus has really started skewing towards really high quality users. So we're really registering, re-engaging, and reaching back out to users over time. And so we're doing that through things like vertical integration. We recently bought a mortgage broker. A couple of years ago, we bought a small business loan broker. We've talked about getting into other vectors of financial services. And we're also registering and re-engaging users. We launched a robo. We now offer the ability to invest in T-bills. We've got Nerdwallet Plus, which has a great rewards program. So all those things are really focused on driving more from the users we do have.
Got it. Okay, so extracting more value from the existing users. I'm curious how the price action in financial markets, the record highs that we've seen in stocks, the volatility that we've seen in fixed income have affected your financials.
Right. So I think in terms of our outlook for 25 and 26, that's been affected by the 10-year rate rising. Parts of our business are oriented towards lending. So, for example, in mortgages are more expensive, driven by the 10-year rate. People are less likely to refinance. The same with small business loans. We see small businesses are a bit more tentative in terms of taking out loans, given some of the stuff that's happening, I think, with tariffs, as well as workforce issues in areas like construction and ag. That on top of the rising 10-year, probably muting demand a bit there.
I'm curious, too, about just consumer activity in general, Tim, specifically when it comes to loans and personal loans, and how that feeds through to your business, and whether some of the softness, if you will, that maybe we saw there is specific to Nerdwallet, or is that more of a broader industry-wide trend?
Yeah, so in the industry, there's quite a bifurcation, right? Financial institutions are bending over backwards to give incentives and to attract prime and super prime customers. That's been consistent since before the pandemic, and increasingly so. And then the big shift you've seen over the last 3 or 4 years has really been in the near prime and subprime segments. That really went into a deep freeze over the last 2 years. We are actually starting to see signs that it's thawing out a little bit. Underwriting has improved on that near and subprime segment just a little bit, and we're seeing a little bit of signs of life coming back into that market. So that's just been a slight improvement in the last quarter.
When you talk about the underwriting conditions have improved, is the idea here that they are willing to take on, higher risk borrowers, or are they still kind of sticking with the lower risk borrowers, but willing to extend more credit to those names?
There's healthy appetite for prime and super prime. I think on the subprime and near prime side, we're a lot lower than we were 2 or 3 years ago, but marginal improvements coming back there in terms of willingness to lend.
I want to go back to the search traffic and Google's algorithmic changes and how that impacts you, particularly search traffic for Nerdwallet content. How do you balance that with expectations that Gen AI is going to play a larger role in how these search companies move forward and how you plan to position for that?
Yeah, so we think about this big picture as just being helpful to consumers, right, and meeting them where they are. So what we're seeing in terms of the numbers, more people are still using Google this year than last year. And there's triple-digit growth, however, in people using LLMs. And so I think what we're really seeing more broadly is incremental use cases for people asking computers more stuff, right? Within Google, we are also seeing them work hard to improve their search results. In some cases, it's AI overviews. In some cases, they're adding different types of modules. But I think all of those things improve the ecosystem ultimately, and I think that's good for everyone.
All right, Tim, appreciate you taking time for us on what I know is a tough day. Tim Chen, the CEO of Nerdwallet there. The share is moving lower here on the day. We do have some breaking news crossing the Bloomberg terminal. This involving Citigroup, of course, the third largest bank in the U.S. by assets, ending workplace representation goals and removing requirements to interview job candidates from diverse backgrounds. That is the news. It's based on an internal memo that Bloomberg News reporters have seen, effectively ending its DEI programs. The company is saying that it will rename its diversity, equity, and inclusion and talent management team to the talent management and engagement team. Of course, a lot of these changes coming against the backdrop here of a new administration in Washington that has pushed back hard on some of these DEI initiatives. Coming up here, we're going to continue our focus on some of the big movers of the day, and that includes Capital One adding a winner to its wallet, according to Bank of America. This after shareholders gave the go-ahead to finally close that deal with Discover Financial Services. A closer look up ahead of that $35 billion merger and top calls. That's coming up next right here on Bloomberg. All right, time now for our top calls. A look at the big movers on the back of analyst recommendations, and we're going to start today with Roku. Jefferies, which started coverage last year with an underperform rating, is upgrading that recommendation today to hold. The analyst citing the strength in last week's earnings reports. Jefferies also nearly doubling its price target to 100 from 55, with the analyst saying the bear case has weakened and there are multiple tailwinds for growth in fiscal 2025. The shares, though, slightly lower on the day. Next up, Lam Research. Susquehanna dipping into the chip equipment company, upgrading its call to positive and raising its street low $75 price target to a street high $125. This follows Lam's Investor Day, where the analyst took note of the company's long-term 2028 earnings target and said Samsung, one of the top customers for Lam, has the potential to lift EPS expectations for the near term. Those shares up 1.5%. And finally, let's take a look at NVIDIA. KeyBank nudging up its price target to 190 from 180 ahead of that earnings release next week, which the analyst says the chip maker should solidly beat. KeyBank cites the potential for higher than expected output of NVIDIA's Blackwell B200 chips. Those shares up 0.5% on the day. And those are some of our top calls. Another name we're keeping an eye on is Capital One. Bank of America upgrading the banking company to buy from neutral. The price target going up to 235 from 207. The analyst positive that the company's merger with Discover Financial Services should pay off, saying the deal will provide meaningful strategic and operational upside in the longer term. The analyst behind that call, Mihir Bhatia, joins us right now, senior consumer finance analyst over at Bank of America Securities. All right, I know there's a couple more hurdles for this deal to get done. They say it's going to get done by the end of the second quarter. Assuming it does, what is the immediate upside here for the combination of these two companies?
Sure. So in the short term, the immediate upside, you really have two different areas, expenses and revenues. On the expense side, we think there's a plethora of expense synergies that are available. Particularly, you just don't need two operating infrastructures for both the companies. As a result, Capital One has laid out a path to about $1.2 billion to $1.3 billion in expense synergies on the expense side. And then on the revenue side is really where it gets exciting, is Capital One has a large debit portfolio Discover has a debit network. Discover earns uncapped interchange, and Capital One earns capped interchange. So this is a law that was passed a few years ago, coming out of the global financial crisis, which capped the interchange rate on debit cards. As a result of that, there can be a pretty meaningful upside. We estimate over $500 million of revenue synergies just from the debit volume at Capital One moving from Visa, MasterCard to Discover. And then on top of that, you'll get synergies on the credit volumes moving.
Does this potentially, though, increase? I mean, I know combined, obviously, they have more users, but does this provide a net increase overall long term in the number of folks using their card and, more importantly, how much they use the card and the places that accept it?
So the combined company would have about 150 million cards outstanding. In terms of whether more people will use their cards, it'll be interesting to see. I mean, there probably might be some dyssynergies actually a little bit early on, because I imagine there's a few folks who have both a Capital One and a Discover card. That said, I think where you'll start seeing some of the synergies is as Capital One executes on its longer-term strategy to grow acceptance, right? To grow the perception of acceptance. Discover is actually accepted at 99% of retailers and merchants today, 99% of what Visa and MasterCard are. However, the perception is Discover is not widely accepted, and as a result, usage of the Discover card is a little bit lower. What Capital One has said is it's going to invest heavily in improving that perception, and as that perception improves, you'll see Discover, more volume on the Discover network. You'll also have Capital One volumes, Capital One's own cards, moving to the Discover network over time, and that will also boost network volume on Discover. So you can actually see the Discover network gaining pretty meaningful volumes.
Okay, but at the same time, Discover is not really as prevalent overseas, outside of the United States. And I'm wondering how problematic that could be as Capital One migrates its cardholders to that Discover network.
Yeah, no, that's a good point, and that's one of the reasons why we think Capital One's going to be a big Visa, MasterCard customer for many years to come, as they build that international acceptance footprint, right? But you have certain programs, if you have a secured card with Capital One, chances are that's a consumer that's probably not doing a lot of international travel. If you have a lot of students have Capital One credit cards, those people are probably, not doing a lot of international travel. Keep in mind, Capital One has the data on where consumers are spending their money. So if they see certain consumer groups with not a lot of international travel, that's an area where you can certainly move. But a portfolio like the Venture portfolio or the Venture X, which is a very travel focused, you probably wait to move those a few years.
Got it. Mihir Bhatia, thank you so much. Senior Consumer Finance Analyst at BofA Securities. And Romain, I know that you care about your airport lounges. Have you gone to a Capital One lounge?
No, but I know who's there's the new lounge in LaGuardia that Chase did, and it's wonderful. It's wonderful.
They let you go in?
Yeah. Well, first of all, they keep the riffraff out. First of all, which is, of course, I'm a snob, and but also, it's just a much better experience, much bigger, and everything else. So I don't know. We'll see if Capital One Discover can up their lounge game. I love talking
to Romain about the lounges. He gets so worked up about it.
Blow the break. I have a lot more comments on this.
Coming up, we'll speak with Dean Carignan, Director of AI Innovations at Microsoft.
The U.S. productivity, I think, I've been meeting with a lot of the tech leaders lately, and I think we are very close to the cusp of this AI finally coming into the productivity numbers.
Scott Bessent, the Treasury Secretary of the United States, on Bloomberg Television earlier today, discussing how AI is going to affect the economy. This is the countdown to the close. I'm Romain Bostic. I'm not AI. Are you?
I'm not AI, not yet.
But one day the AI probably will replace our jobs.
We'll both be replaced. That's the fear.
Yeah, but I thought it was interesting, his comments, and he only kind of gave a brief comment about this. It's a very wide-ranging interview, but he really talked about the potential for productivity improvements, and this really does seem, at least for a lot of companies, seems to be the holy grail in terms of the use case for AI is how does it make your company more efficient and obviously more cost-effective.
Absolutely, and that's why they're spending all the big bucks right now to get to that point. Of course, investors have gotten a little less patient with that spending, at least in the last quarter or so. Speaking of tech and AI, our next guest is the Director of AI Innovations at Microsoft, and he has just released his new book, The Insider's Guide to Innovation at Microsoft. Dean Carignan joins us now. Dean, welcome to The Close.
Thank you for having me.
So the focus of your book is really about responsible and experimental innovation in the AI era. Microsoft, which is an investor in OpenAI, obviously has a lot at stake here. So I'm curious to get your initial take on the Chinese AI startup DeepSeek. Is DeepSeek an example of responsible and experimental innovation?
It's a great question. I could probably spend the whole afternoon talking about it, but I think it is innovative in two respects. It has a very unique and novel training method that allowed them to train it more efficiently and more cost effectively. What was equally surprising, though, was their decision to open source the model and not put it behind a paywall and charge for it. One of the things we write about in the book is that multiple forms of innovation, technology plus business model, tend to really shake things up and tend to be hard to replicate or follow. So I do think what they've done is interesting. We have to kind of see how it all plays out, but it's definitely new and unique to the industry. So we talk a lot about OpenAI and ChatGPT and how some people are experimenting with it, but then you've got, analog people like me, and I think Romain to some extent, who are a little bit, more skeptical of it. How different is the AI that people are using now going to be in 5 years' time? Yeah, another good question. I think this is the year that we're starting to see a shift into what at Microsoft we like to call human-centered AI. Human-centered AI starts with the question of what should the AI systems do, not what can they do. And that's kind of the inversion of the public discourse about AI today. So much of it is about the models themselves, the capabilities, how they've been evaluated. I think what we're starting to see is more of a starting point on the user, the person, the customer, and what they need. And that allows you to be more intentional in which systems you choose, how you roll them out, and how you extract value from them. So I think we're reaching that pivot point, and hopefully we see more value deriving from the systems this year. I am curious too, and this kind of goes to the DeepSeek question as well, but also about the cost effectiveness of it all. I mean, there's been an arms race right now to acquire, of course, the goods to actually even do the work. The question is, when do we get to a point where that is genuinely cost effective and there's a true return on investment for the end users, whether it's a company or whether it's a consumer who's licensing one of these chatbots? Yeah, I think it's so important to watch this. And if you look at the research that comes out every time a new model releases, the electricity consumption, the cost of running the models drops by a factor of 2 or more almost with every release. And DeepSeek was kind of the next step in that iteration. So there's kind of two things going on at the same time. One is there's a lot of effort to make data centers more efficient, but the flip side of that is making the models more efficient. And I think we're kind of reaching a tipping point where those things will start to show up in the sustainability numbers and commitments and other things. I am curious, though, about all of the competition in this space. And you have some very different visions of what AI should be. Should it be open source? Should it be nonprofit? Should we just treat it just like any other sort of capitalist enterprise here? I don't want to ask you what's the right approach, but I am curious as to how far we've come today would have been maybe quicker had we had a more unified approach in the research and development of this technology. Yeah, another great question. So in general, competition is good for the consumer. It creates choice. It creates options. When it's not good is when it moves so fast that it creates risk. I can certainly speak about how we approach that at Microsoft, which is a term I like to call featureization. We think of safety not as a requirement or an obligation, but a feature of AI. And when you treat it like a feature, like any other feature, speed, efficiency, capability, intelligence, you do what we call shift left. You build it into your planning and design process and you emphasize it from the start. And when you do that, you don't end up with a situation where you're about to ship and you think, oh my God, now we have to make these systems safe. So we share a lot of what we do. We open source a lot of our safety systems and we try to help the whole industry to go in that direction. How safe, though, is that data, though? Like when I look, at least in the consumer-facing part of this, if I'm using Copilot or something like that in a Microsoft product, do I have an assurances that what I'm writing on Microsoft Word or in Excel is not somehow going to be co-opted? Because, I'm doing a lot of sensitive things. Yeah, and that is one of the ways we've really tried to differentiate by guaranteeing that if you're using one of our experiences, your data is not being used to train the next generation of models. Not all providers do that, and certainly when you're into kind of smaller companies, it's less, but I think we've got the right assurances in place, and we've had privacy teams even before we had AI safety teams.
Yeah.
So we stack all these layers of protection, and we call it defense in depth. And so I think we're doing a good job.
What country or institution is leading the way, is doing the most admirable job from where you sit in terms of ensuring safety, setting standards, making sure that the rules of the road are being adhered to, if there are rules of the road?
Yeah, we're kind of making the rules up as we go, which is always fun. But I think one of the most important institutions right now globally is the AI safety institutes. We've got one in the US, the UK. I believe there's 4 or 5 other nations that have created these institutes. They employ scientists to understand AI. They employ engineers to build AI safety mechanisms. And they collaborate really closely with the private sector. We're talking to them every single week. And so I think that is how we can have kind of a global approach to systematizing and standardizing the way we come at safety in AI.
So earlier on, we were joking about how Romania and I will be replaced by AI one day. And I know that you have a statistic that says by 2030, about 300 million human jobs will be replaced by AI. What kinds of jobs won't be replaced by AI?
Yeah, and I like to think that portions of jobs can be replaced. But if we are reactive and embrace AI, it doesn't mean that entire roles have to go away. So everyone's job involves 2 components typically: creative, interesting, cognitively engaging work, and drudgery. And where AI really shines is taking away the drudgery. And so that's what we encourage everyone to think about. Break your workday into those 2 things. Proactively embrace AI on the drudgery and free up more time for you to actually engage in the things that are uniquely human: creative thinking, empathy, engagement with other people, coalition building, inspiring other groups. So I think it will lead to more fulfilling jobs. And if we're proactive and intentional, we can respond and actually use it to kind of improve the way we work.
All right, well, it's exciting times here, and I think we're all hoping for that vision of the future and not necessarily some of the more pessimistic ones here. A great conversation and a great book. Dean Carignan, AI Innovations Director at Microsoft and the author of a new book, The Insider's Guide to Innovation at Microsoft. Speaking of AI, we have some breaking news on Alibaba. Of course, the stock on a tear, up 60%. The ADRs here in the U.S., largely on the back of some of those AI initiatives. We're now learning that Ryan Cohen, of course, famous for taking a big bet on GameStop, has now boosted his stake in Alibaba to about 7 million shares, or roughly about $1 billion. Alibaba shares had already been higher on the day. They're up about 9% right now. We'll try to get you some more details on that.
So this makes Alibaba the new meme stock? It feels like it, right?
Well, maybe.
You've got Ryan Cohen's name attached
everything
to
old
it.
is new again. And, Jack Ma's apparently back in the fold here. They've got a partnership with Apple and a partnership with some other companies here. So definitely one of the biggest stories, at least in the tech space, certainly in the Chinese tech space of the last few months.
And Alibaba ADR now at the high since November of 2021. So yeah, maybe it is meme stock.
All right, we're going to dive a little bit deeper into that and take a closer look at some of the other stocks moving on the day. Walmart going in the opposite direction here. We're going to explain why. We got 2 stocks of the hour coming up. This is The Close on Bloomberg. Time now for our stock of the hour. Shares of Walmart down after the retailer's profit forecast was a little weaker than what Wall Street was expected. Some concerns here about the pace of consumer spending. On the flip side, though, one of the biggest gainers on the day, the ADRs of Alibaba up about 9% after that company posted results that beat estimates driven by AI optimism at its cloud unit. Jess Menton joining us right now to break it all down for us. And let's start with Walmart, of course, the world's biggest retailer in the world's biggest economy, saying, well, okay, maybe, just maybe, things aren't going to be all that great for the full year. Some people are kind of saying, oh, don't worry about this. They do this every year. They start off the year, they give a tepid forecast, and then they beat it down the road.
Because we also, to your point, we see companies lowering the bar to more easily beat those expectations. And because this is some of the data that we've beginning to see in Bloomberg Intelligence's data, as well as guidance so far for the first quarter has come in below analysts' expectations, but only about a quarter of companies give out quarterly guidance, and it's usually dominated by tech and discretionary companies. But in particular, when it looks at Walmart, down 6% on pace for its worst day since November 2023, you have to think about how the stock has been trading. It's been trading like a growth stock over the last 12 months. So even before today, if you went through the 12 months through yesterday's close, it was up about 77%. So that's better than how Apple traded over the past year, how Google, Microsoft. The only ones that really did better in the Mag 7 cohort was Nvidia and Tesla. So it outperformed all of those. And then if you're just looking from a PE perspective, what it was trading at, it was at 30 times projected earnings over the next 12 months. Amazon's only around 31. I mean, that's still obviously relatively elevated, but the Mag 7 is at 30. So that was a big leap we've seen over the past year because it had lagged Costco and Amazon in recent years with stock performance.
Yeah, it's kind of interesting, too, that we've been talking a lot about how investors have been rotating around various sectors and various stocks here. And I'm going to kind of use that as a segue to talk about tech, but not U.S. tech. And it's kind of the re-emergence of Alibaba, the re-emergence of Jack Ma. I don't know where he's been for the last couple of years, but now apparently he's back in the fold. And this stock is on fire. It's up 60-something%. We just had a headline a little while ago saying that Ryan Cohen, famously of GameStop, boosted his stake in Alibaba. Everybody's in this stock right now.
And I remember being on the floor of the New York Stock Exchange when that company went public. It was September of 2014. But in that span, that stock's only up around 100%. So if you compare that to Amazon, Amazon's up about 1,200% in that time frame. So obviously there were a lot of growth concerns about how it was going to continue to expand. But you're starting to see part of its models, and you mentioned it, part of the AI and the cloud type computing looking at its quickest pace in revenue growth since 2023.
But how significant is it to have someone like Ryan Cohen, visibly take an increased stake in the company? I mean, he is synonymous with, getting the day traders on board and creating these meme stock moments. I'm just looking at the volume in Alibaba's ADRs. Right now, it's about 272% higher than the 20-day average.
And especially because this, if you're looking at the market cap added today, around 27 billion. But with a name like Ryan Cohen, when you think about especially the height of the meme frenzy in January, February of 2021, when you think about what he was doing at Chewy, obviously the ties into what's happening with GameStop. I mean, this is something that you obviously are attracting a lot of attention to this, but also, I mean, these are U.S. listed ADRs for China. I mean, you're also seeing Billy up a lot today, too, when you're thinking about that side of the cohort. A little bit of a different company, though, when you're thinking about that type of video platform, but you are seeing the NASDAQ Golden Dragon Index up around 1.5%, and Alibaba is about, I think, 10% of the weighting, 11% of the weighting. So obviously, it's really driving.
But is this also just about kind of valuations too? I mean, people aren't bidding up Amazon in the same way, or not bidding up Microsoft, et cetera, et cetera.
Right, they're beat up stock.
I mean, this was a beaten down stock, and now it's saying, hey, look, there's some life here. Right?
And even though we're seeing Walmart, we were just talking about the PE compared to the Mag 7. I mean, the Mag 7 is still relatively elevated, around 30 times forward earnings. So when you're looking at some of these other corners, especially in recent years, since the Mag 7's been carrying this bull market run, you're starting to see these other sectors. And then even in the flows, if you're looking at what's happening in China as well as Europe, you're seeing the flow shift. So it's not necessarily a bad sign for U.S. equities. It's just you're starting to see this broaden out in other corners. And that's actually a good thing for breadth and market breadth.
I mean, one thing Alibaba has in its favor is that it doesn't have to worry about Chinese tariffs or the tariffs on Chinese imports, right? Because it's not physically importing things into the U.S. the way that Walmart has to deal with Chinese tariffs. And the fact that their forecast didn't even really make any explicit assumptions about the tariffs that might be coming.
Yeah, absolutely. Yeah.
All right. So just really fascinating conversation. A tale of two retailers, really. Alibaba moving in one direction, Walmart moving in the other. Thank you so much, Jess Menton of Bloomberg News. All right, we've got about just over 10 minutes to go before the market close, and we want to show you where things stand when it comes to equity markets. It's a down day here in U.S. stocks. The S&P 500 still down about 0.5%. So if there's going to be a late rally here, it's got to happen in the next 12 minutes or so. What we've seen so far is a weakness in financials. And I bring this up, Romain, because they were the best performing group so far this year, not just in the U.S., but globally as well. Yeah, and I mean, obviously, a lot of this has to do with the rate environment, the dollar environment, and I guess more broadly, really just what's going on in Washington. And I was kind of actually surprised by how swiftly the market did react to some of those comments out of Besant. I mean, what he said wasn't necessarily new, and it seemed to be in line with what Trump himself has said. But it gets to this idea of a market that probably wasn't necessarily positioned in the right way, at least in line with what Besant said today. Or it's just looking for any kind of confirmation, any kind of assurance that someone from the administration can offer, because there's a lot of competing headlines coming out at any given moment. Yeah, absolutely. Competing headlines coming out of Washington, coming out of New York, as well as Miami.
Major investors from across the globe are down there for that Future Investment Initiative conference. It did have an appearance by President Donald Trump. Also on the ground there is our very own Manus Cranny. And he's joined right now by Barry Sternlicht, the chairman and CEO of Starwood Capital Group. Let's go down to Manus. Manus, take it away.
Romain, thank you very much. Good to be with you. Yeah, Barry Sternlicht joins me here. We had the president here last night. Barry, good to see you. And he was in full flow in terms of what he wants to do, onshoring, tax, AI, data centers. You've had about a month and a half now. What's the biggest opportunity that comes to you as you listen to the president on a number of occasions now?
I mean, business is feeling empowered. You know, I think the prior presidents didn't have a lot of business experience. Neither Obama nor Joe Biden had really been in the business community. So the business community is excited and nervous too. I mean, we're excited about the deregulation. And for me personally, cutting government waste, and the first candidate who actually has talked about being more efficient. Like, I'll pay higher taxes. I don't need lower taxes, but I want the government to use my money wisely. I don't want to throw it away on programs that don't make any sense. So I think a business approach to the federal government spending, which is gargantuan, is really great for the country. And I hope this team, that's, you have one of the smartest people in the world leading the efforts, it just needs to be careful. I think, this isn't a company. This is the country, and there are other countries involved. And you got to be careful how you cut. I don't think I'd do it quite boom. I think I'd look at each program one by one and say, this makes no sense, but this one makes sense. I don't think they all don't make sense. I think, as Jamie Dimon said last week at a conference, we should America first, but not America alone. And I think we have to be careful of that.
Scott Bessent was with Bloomberg Television this morning. He talked again about the ambitions on deregulation in your world of the hotel world, of the
real estate world.
Real estate world, yes, the broad church. What is the most profound deregulation that could help your business?
The speed to get a permit to build a building, and we're in the data center business, one of the largest players in the country, and it's really hard. But the federal government can only do so much. There's going to be pushback from the local communities, from the states and municipalities that today govern a lot of the zoning, and the states really require. I was talking to our team earlier today, and it'll be a year before we can get a permit on a deal. Well, we would all like to see these. It's in the public's best interest. Even if you want to build a housing project, it takes forever. So, to shorten that and make government, not just the federal government, but local municipalities and state governments more accountable to having a goal, having an effort, we want to approve 200,000 housing units this year, and we're going to get it done. Just move faster, because the capital is ready to go, but sometimes the bureaucracy keeps us from going. So that stuff is good and good for the economy, and that will help the economy grow.
Barry, this is Romain in New York. I am curious about the tariff picture, and I know it's going to take a few more months before we actually learn if Trump goes through with some of these tariffs. But what would the net effect be on real estate development, given the sourcing of a lot of the materials that go into building?
Look, the promotion of American manufacturing is a great idea, but we are not a manufacturing nation. We only have 13 million jobs of 160 million in manufacturing, and we're running a 4% unemployment rate. So I'm not sure who's going to work in all these factories. We're going to need some really quick efforts from Musk and Zuckerberg in robotics to actually have people work in these factories. Americans don't want to do that. That's not the jobs that they're interested in taking today. So I think the tariffs are super complicated, and you don't know what's negotiation and what the end result is. I do think the focus should be on China. We run a $250 billion trade deficit with China. It's not Canada, for sure. And I think we have to be careful where we pick our fights. But China is really the country that runs the second largest economy in the world with a fixed currency. And that alone is not right? That currency should go up and down and with trade flows like every other major currency. So you start there. And I don't think the tariffs, they're tactical. If you put them in place, as he just did the steel tariffs, I think they're going into place, American companies will raise prices. So it is very inflationary. And for real estate, it's really bad. Because for Canada, lumber, we need the lumber, or we can chop down our own trees, I suppose. But it's not a bad thing. We run an equal trade deficit with Canada other than oil. And we use their oil, and if we don't buy it, they're going to ship it to Asia. So I think it has to be, look, he's got there's a lot of cobwebs to get through, and I think he's sort of slashing at them. And I think I think they'll work it out. I'm optimistic. He's going to be our president, and I want him to win. So I would hope that this. It's very inflationary, though. And look, for existing owners, it's good. Because to build a new building would be more expensive. So the existing office stock, the existing apartment stock is going to be worth more. But it's bad because the numbers won't work to create new. You won't be able to build anything. And we already have a 4 to 5 million unit housing shortage. So he's going to create. And you're seeing it in the sentiment of the builders that they're nervous. Everyone's a little nervous. We're optimistic, but we're a little nervous.
Right.
I wonder how many eggs are going to get broken before the house gets built, right?
So. Oh, don't break any eggs, Barry. Those cost even more than lumber.
So the inflationary effects of tariffs is definitely something that people are worried about, and you see that in the markets as well. What is the single biggest risk, Barry, with the move fast and break things approach that Doge and you could even argue President Trump is using to, fulfill his priorities, that fulfill his agenda?
I merged 3 hotel companies together, and I put a net overall spending so I could check what was going out. And I think that's sort of the approach they used. But people's lives are at risk in this situation. It's not a company, it's the world. So I think and it's countries and programs in countries that are probably important to us. Some of it is actually weapons. It's good to have friends around the world. And the S&P 500, at last I checked, I think 60% of the revenues are international. So we do not want to piss off the entire globe. And in this regard, Russia is irrelevant. They're not a major trading partner at all for us. But we are major trading partners with Europe and with Canada and Mexico. We exported labor, and we wanted manufacturing in Mexico because China was too unreliable, and of course we experienced the difficulties of the supply chain, which actually really caused inflation during COVID. So manufacturers, including the Chinese, moved manufacturing to Mexico, where they have cheap labor, and consumers in the United States benefited from that. So we're going to see how this works out. It's fascinating. It's scary. You kind of want to be in the bleachers as opposed to on the field, watching it. But it creates opportunities for investors, and I think. It's you wake up every morning and it's back to having to watch what happened last night. So it's rapid.
Does that hold you back from wanting to do deals? Are you a bit more restrained? Everybody comes on the show and they say double down on U.S. exceptionalism. Are you a bit more restrained?
Yes, it's adding more risk factors. I mean, for real estate, we want to know if interest rates are going up or down. And last night, Trump said inflation's going down, and interest rates are going down, and the deficit's going down. And yet the more tax cuts are at least projected to increase the deficit. And the theory is we'll grow faster and the deficit will go down. That's a nirvana situation. Will that happen? We're all watching. But when I'm looking at a deal, an investment, I'm now just buying an industrial portfolio. I'm curious, what happens if they were storing things in buildings that the tenant may go bust because of the tariffs coming in on that tenant. Those products will be too expensive and they won't sell. So we have a whole new set of risks, and it will create opportunities. Data centers are, the president's behind them, the nation was behind them, and the Mag 7 were behind them before, President Trump showed up. But now he's trying to get the power, which is the issue, to the data centers faster, and that's good.
Barry, we appreciate your input here in Miami. Good to have you with us on the show. To you in New York, Scarlett and Romaine, good evening.
All right, thanks there to man. That's a great interview with Barry Sternlicht as we turn our attention back to the markets here in the U.S. with just about 3 minutes, 2.5 minutes until the closing bells. We're off the lows of the day, but still in the red, Scarlett.
Still in the red right now, but you do see a lot of movement in some of the sectors that have done particularly well, financials among them, but also small caps down about 0.8% as well, underperforming the broader market.
Quite a few earnings that we have to get to after the bell. You want to stick around for that? Our global simulcast starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Scarlet Food, taking you through that closing bell with a global simulcast that starts right now. Carol Massar and Tim Senovic join us from the radio booth. Alex Steele is out on the day. We welcome our audiences across all of our Bloomberg platforms on a red day across the screen, Carol. And I don't know if that was because of the earnings we got at Walmart, some of the economic data we got that was somewhat disappointing, or some of those comments that we got out of the new U.S. Treasury Secretary.
Yeah, I think yes, and yes. And I mean, I think there's some concerns about the economic way forward, especially if you look at something like Walmart. Even with their high-end consumers, there's some concerns concerns about maybe consumer spending. I keep looking at the KBW Bank Index. It's down about 2.3%. So add it all up, you're definitely seeing some major underperformance when it comes to some of those big bank names.
Should we be taking the Walmart guidance, though, with a grain of salt? Jen Bartashis over at Bloomberg Intelligence says that and reminds us that the company oftentimes puts out a guidance, then lifts it later on in the year. So I don't know.
No, that's a good point. But, just like all the other companies that have given guidance, Walmart did say that it didn't really explicitly include the potential impacts of tariffs because nobody knows. Nobody knows anything when it comes to tariffs.
I think one thing that also spooked people is we did get some other earnings out of Wayfair, out of Birkenstock, out of Freshpet, out of Carvana, a lot of consumer-facing companies. And their sort of guidance really wasn't all that much better. They weren't awful, but again, no one is sort of saying, "Oh yeah, everyone's just pulling out their their wallets to spend money." And I think maybe that's the concern, that if Walmart isn't benefiting, and they're supposed to benefit in good times and bad, then how are those other companies going to fare? Let's get you the closing bells. We have a slew of earnings coming after the bells here, so let's get you the numbers here. The Dow down about 450 points or 1%. The S&P lower by about 26 points or 0.4%. The Nasdaq Composite is going to close lower by about 0.5%, and the Russell 2000 down 0.9%.
Quick check on the S&P 500, Romaine, and kind of an even split. 233 names to the upside, and Scarlett, you've got 268 to the downside.
All right, let's take a look at the IMAP. More red than green. Your worst performers are financials. Carol, you mentioned the KBW Bank Index. Consumer discretionary and consumer staples off by about 1% as well.
Booking Holdings out with its results right now. It looks like a beat on the bottom line here. 4Q adjusted EBITDA, $1.85 billion. The street was looking for $1.65 billion. On an EPS basis, $41.55 per share. The street was looking for $36.37 per share. Revenue in the quarter, also a beat here, $5.47 billion in revenue. The street was looking for 5.18. Gross bookings also a beat, 37.2 versus 34.47 on average. I'm going to look here for a forecast, but not quite seeing it jump out just yet, guys.
Yep, not seeing it yet, but booking shares, as you can see, up about 3.6% here in the aftermarket. Quick check on some of the movers in today's session. Got to point out Alibaba up about 8.10%. We did have a headline, Ryan Cohen, of course, boosting his stake to $1 billion, that from the Wall Street Journal. But the stock was up ahead of that after the company posted its fastest pace of revenue growth in more than a year. So showing a turnaround in its commerce business, also some big strides into the critical field of AI. Keep in mind those ADRs, highest intraday since about November of 2021. So really some outperformance. This stock, the ADR is up about 60% year to date, again on AI optimism and really Beijing's more supportive stance toward the private sector. So been kind of keeping a watch on this one for a while. Quick check on Hasbro. It's up almost 13% here at the close. A top gainer, number one gainer in the S&P 500. Company's fourth quarter adjusted EPS and operating margin topping street expectations. Management also provided medium-term growth targets and introduced its Playing to Win strategic plan. Stock is up more than 20% year to date. Quick. Let's go to Sprouts. Want to go to Sprouts?
Yeah, let's do it.
Okay.
The ticker here is SFM for Sprouts Farmers Market. And we can tell you that the company says fourth quarter net sales came in at $2 billion, slightly higher than what was anticipated. Fourth quarter adjusted EBITDA, EPS, did beat analyst estimates as well, 79 cents. And in terms of first quarter comparable sales, the forecast, it sees at least 10% increase there, whereas the consensus estimate is for a 6.6% increase. That stock barely moving right now, but slightly higher.
Okay, let's go from one food provider to another. BJ's Restaurants shares are moving in the after hours. The company reported fourth quarter revenue that came in above estimates at $344.3 million. Fourth quarter loss per share that came in below estimates at 23 cents a share. Fourth quarter comp sales coming in above estimates at 5.5%. Taking a look at shares in the after hours, higher by about 3%.
All right, just got a few headlines here on Newmont. Let's get to it. Fourth quarter sales, $5.65 billion. That's a beat. The estimate was for $5.12 billion. Fourth quarter adjusted EPS of $1.40 a share. Again, that's some outperformance. The street was looking for about $1.06 a share. So their fourth quarter free cash flow also beating estimates. And this stock, which has been on quite a run already here in 2025, seeing a bump up, remain up about 3.7% here in the aftermarket.
Yeah, kind of interesting, too, to see some of those cash flow projections as well here. We're still waiting on some other earnings, including out of the Real, Texas Roadhouse, and in Rivian, something that I'm actually interested in here, given some of the concerns people have had about EV adoption and whether some of these upstarts, particularly in the wake of Nikola's bankruptcy, some of these upstart EV companies have a little bit more, gas in the tank. Is that the right?
You can still say that.
What?
Makes sense.
I like
That's
the
all I
metaphor
got.
works. The metaphor works. I mean,
Electrons
more
in the
charge
battery?
left.
Electrons in the battery?
Electrons in the battery.
How does that work?
Okay, I go for that as well.
I just want to go back to, you know what? We have Dropbox results coming out. Dropbox saying fourth quarter EPS coming in at, on an adjusted basis, at 73 cents. That is 11 cents higher than the consensus estimate. Revenue was $643.6 million. That is also better than what was anticipated. Dropbox right now down about 1.4%. We're still looking for details on any kind of outlook that it's giving.
Okay, let's go to Texas. Texas Roadhouse shares are higher right now by about 2%. Fourth quarter revenue came in just above estimates at $1.44 billion. Fourth quarter earnings per share above estimates at $1.73. The company increasing its quarterly dividend to 68 cents a share. They also okayed a stock repurchase program of $500 million. Shares higher by 2% as we speak.
All right, just going quick backly to Newmont because we're seeing that one up about almost 2% here in the aftermarket. Of course, a read on the mining. Some outlook sees 2025 attributable gold production about 5.9 million ounces. I'm looking for some kind of comparison. So I'll wait till we get that. Let's go on to Rivian.
Yeah, Rivian earnings are out. A loss per share, not unexpected here. 70 cents. Revenue coming in at about $1.73 billion. That's well above what the street was looking for at about $1.39 billion. Company now says that it has about $5.3 billion in cash and cash equivalents. That's a little bit lighter than what the street was looking for. They were looking for roughly about $6 billion in cash on the books. And here's your forecast. The company's saying that for the full year, it expects to deliver 46 to 51,000 vehicles. That is below street estimates. The street on average was looking for deliveries of about 55,000. And as far as its adjusted EBITDA loss, the company says that for the full year, that loss will be in the range of $1.7 billion to $1.9 billion. Shares down about 4% here in the after-hours trade.
All right, let's take a look at RealReal, which is an online marketplace, consignment marketplace for luxury goods, coming in with fourth quarter revenue of $164 million. That matches the average analyst estimate. It did report a loss in the quarter, an adjusted loss of 1 cent per share. That was narrower than what analysts had anticipated. As for its outlook, it has maintained its first quarter revenue outlook, 157 to 161 million. The midpoint of that range does come in below the average analyst estimate, and it has also maintained its full year revenue and adjusted EBITDA outlook. So coming in higher than anticipated when it comes to the, or I should say better than expected when it comes to the bottom line for the fourth quarter, but the outlook is maintained.
All right, let's look at shares of Mercado Libre, which right now just surging in the after hours by 13%. The company reported fourth quarter net revenue that came in above estimates at $6.1 billion. The EPS, though, on the bottom line, that really came in above estimates at $12.61. Estimates were for $7.91. Shares right now jumping in the after hours by 11%.
All right. We also do have Live Nation just crossing the Bloomberg terminal. Fourth quarter revenue, $5.68 billion. That's pretty much in line. $5.63 billion was what the street was expecting. Fourth quarter adjusted operating income of $157.3 million. That's a little bit better than what the street was expecting. They were looking for $141 million. Stock is just little changed here in the aftermarket, guys, just down about 0.2%.
I just want to bring your attention real quickly to Floor & Decor. I mean, Mercado Libre was actually the biggest gainer in the after-hours trade. Now that title actually goes to Floor & Decor, a big maker of flooring, of course, for furnishings here. The company's given a forecast for 2025 that looks to, somewhat more bullish than what the street was looking for, $4.9 billion on the revenue side. On net sales, the street was looking for about 4.85, and the company says that comp sales should be up from 0 to 3%. The street was on average looking for about 1.8%, so the top end of that range would be almost double of what the street was looking for. Those shares up about 14% in the after-hours trade.
All right, a bunch of earnings here after the closing bell. All right, we'll watch and see how they continue to trade and then, of course, carry them over into that Friday session. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. We'll see you again, same time, same place tomorrow.
And stick with us, a deeper dive into some of those earnings, including a closer look at Rivian and the broader outlook for EVs. Jessica Caldwell over at Edmunds. She'll be joining us in just a second, right here on The Close on Bloomberg.
countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Whatever animal spirits we had in this market, at least for today, seem to have completely disappeared. It could have been a lot worse. Stocks were down more than 1% on the day, finishing out roughly down about 0.4 to 0.5%, depending on which index you want to look at here. But there was some real damage under the hood. Take a look at the second line of your screen. That's this S&P Hotels Index, but it includes a lot of the cruise line operators having one of their worst days going back to 2022. And a lot of that had to do with some comments that we'll get to in just a second out of Howard Lutnick, the Commerce Secretary. You also saw bank stocks take it on the chin on this day as well, down about 2%. Yields also dropped, and some of that had to do with the comments that we got out of another cabinet official. And of course, that was the U.S. Treasury Secretary Scott Bessent. But you wrap that all up with some relatively disappointing earnings out of some retailers here, and you get a sense here as to why market sentiment overall was a little bit dour today.
Yeah,
Scarlett.
a lot of questions about consumers and their ability to spend going forward. So let's start with Hasbro, because Hasbro, of course, consumer-facing toy maker, it was the biggest gainer in the S&P 500. Fourth quarter adjusted EPS and operating margin did top analyst estimates, but what really impressed investors was it's providing targets through 2027, mid-single-digit sales growth and about $1 billion worth of savings. Then you've got Walmart and Royal Caribbean. You can see Walmart down about 7% right now. Full year profit, its outlook came in lower than expected, which is what it typically does at the start of the year. But the stock has jumped about 77% over the past 12 months. So investor expectations were clearly very high heading into this print. And Royal Caribbean, Romaine mentioned the cruise line operators down about 7.6%. Howard Lutnick talking about possibly how these companies would need to start paying taxes to the U.S. We'll dig into that a little bit later on. But all of that brings me to our top story this hour, which is what is next for travel demand. We know billionaire investor Stanley Druckenmiller is betting on airline stocks. The latest 13F filings show his family office added shares of legacy carriers United, American, and Delta last quarter. And we just learned online travel company Booking reported sales that beat analyst estimates. Now, later in the program, we're going to catch up with the points guy on the outlook for the sector. Brian Kelly, the CEO, will be joining us.
All right, before we get to that, some breaking news on Block, the company formerly called Square. It has changed the ticker from SQ to XYZ, but still a lot of the same. The shares down in the after-hours trade after the company said adjusted EPS came in at 71 cents a share. That was well below street estimates. On average, they were looking for about 89 cents a share. Net revenue in the quarter also missing at $6.03 billion. The street was looking for $6.28 billion. But going forward here, the company is also saying that its gross payment volume did come in a little bit higher in the quarter, and that for the full year, it is expecting to maybe come in line with some of the key metrics, including operating income. It says on an adjusted basis that should come in for the full year at about $2.1 billion. That's exactly what the street was looking for on average. We're going to dive a little bit deeper into that in just a second as you see those shares moving lower. But we want to flip up the screen and take a look at Rivian, because those shares are moving higher. The EV company did report results. It beat on several key metrics and missed on others. Revenue was up in the quarter by 32% to $1.73 billion. The company still posting a loss on basically an adjusted basis and on an EPS basis. That will continue, but those losses will be slightly less than what the street was looking for the full year. Jessica Caldwell joins us right now, the head of insights over at Edmunds. And Jessica, I want to start out with the forecast here because the company said something interesting in its statement. It talked a lot about this idea that there's still a lot of policy uncertainty, and that could actually weigh on sales. The idea of tariffs, obviously tax breaks and other things that sort of help to facilitate sales of EV vehicles. And I'm wondering if you're anticipating any sort of clarity anytime soon on some of those issues that might give investors a little bit more comfort in some of these EV stocks.
Yeah, I mean, hopefully so. I mean, the big one is the IRA tax credit, because that's a $7,500 tax credit that a lot of people use towards leasing. That makes leasing really affordable for EVs. That's really helpful for a company like Rivian. If you look at their product, it's pretty pricey, but if you get it down to a monthly payment, it becomes a bit more manageable. I'm thinking that maybe in the first 100 days of Trump administration, we'll have some idea whether that's going to stay or go. It feels like it's going to go. There's been definitely cuts in infrastructure spending as well, which weighs on consumers' mind too. So there's not too much clarity, and the market does feel a bit topsy-turvy. And I think that gives people pause to buy, and obviously people, wondering what the stock price will do.
The other issue that they're contending with, and all automakers are contending with, are, of course, a lot of the noise around tariffs and just what the trading relationship is going to be with a lot of the countries where we source the goods to make these cars or assemble these cars as well. Do you anticipate that there will be any sort of reprieve for those companies, or do they have to adjust to a world where they're not just going to be able to hop across the border in Mexico or Canada or get whatever they need overseas from China?
Mm-hmm. This is, obviously probably what's keeping a lot of auto execs up at night, because if implemented, this can really change everything. Not only from a cost structure, but also even from an administration structure. Just trying to track parts that go across the border from the United States to Mexico. Sometimes parts will cross multiple times before they're even finished. So even tracking that becomes an absolute nightmare. What we are seeing is that they are being kicked down the road. There seems to be a pause on, tariffs from Mexico, tariffs from Canada. Is this a bit more bark than bite? It feels like we have seen this storyline before. But what we do know is that cars are already expensive. You look at new vehicle prices, the transaction prices are close to $50,000 on average. You start adding on tariffs, how many people in this country can start to afford new cars? That's a big problem too. But for car companies, they know that this could be a short-term thing. In 4 years, we could have a new administration with a completely different outlook on this, which changes things. So it's just really tricky to plan for the short term, but also keep your eye on the long term and making sure you are changing with technology and becoming efficient, all those other things that they have to do.
Jessica, are consumers just no longer in love with electric vehicles?
Consumers still are demanding electric vehicles. I don't think that is the big issue. It's just they have to get used to them. We saw a lot of early adopters buy their vehicles. Market share for EVs is still under about 8% right now in the US. But it is going to the mass market crowd. And that's probably when you need the most push, the most financial reward for these people to go out and buy them, because they're worried about batteries. They're worried about infrastructure. They're worried about charging. So to incentivize these people is probably more needed than we have needed in the past for these early adopters. So to kind of take the tax credit off at this point, it's sort of hitting at the wrong time when you look at it just from a market standpoint.
Can a name like Rivian ever become a mass market brand for consumers?
It can. You look at their product pipeline, it looks like they're targeting lower cost SUVs with the R2 and the R3. Those are smaller SUVs. Looks like the R2 coming out next year, they're targeting a price point of about $45,000, which fits with the market a lot better. Obviously these new brands, they have to have a lot of spend so people know who they are, know what they're about. But in terms of offering an SUV, offering something that's affordable, that kind of hits right now at the American markets. I think from that standpoint, they're doing well. There's probably a lot of brand building is what's going to have to happen.
And just real quickly, Jessica, though, on that point, though, if we are headed towards, maybe tougher economic times, not awful, but where people are much more focused on their pocketbooks, does that end up benefiting, some of the ICE vehicles, which at least based on my own search for a car in the past year, seem to be much more competitively priced than what we saw with EVs and even to a certain extent hybrids?
Yeah, there's just more options in the ICE market. So you can have something that is small, that is cheap, and those options do exist. But right now, if you're just looking at a monthly payment, there probably is no better deal than an EV that is new, that is leased because of that tax credit. So it gets you to a really low price point, which obviously a lot of Americans, they budget monthly. They're not looking at total price. So that works. But I do think that, if you look at the broader market, there's just simply more options. When the EV market fills out a little bit more, I think that will become less of an issue. But right now it is hard economically for a lot of people. And a lot of people are just, even turning to the used market just because they're priced out of the new market completely.
All right, Jessica Caldwell, head of insights at Edmunds. Thank you so much for joining us today. Coming up, we're going to stick with earnings. We're going to break down the results from Live Nation, Block, as well as Booking Holdings. You can see they're all moving in the after hours with Block, the decliner there, down 8%. This is the close on Bloomberg. We have been hit with a tide of earnings, so let's get you a roundup of some of the notable movers and bring in Bloomberg's Emily Graffeo, Alexandra Semenova, and Natalia Kniazhevich. Let's start things off with Emily. Emily, you're keeping an eye on Live Nation.
That's right, Scarlett. I'm looking at Live Nation, which is the parent company of the ticket platform Ticketmaster. The stock is up only about 2% right now. They did beat on fourth quarter revenue up at 5.6 $5.68 billion versus estimates of $5.63 billion. That was down 2.4% year over year, perhaps why we're not seeing a huge pop in the stock. But overall, the company was very positive on the future of live music. They said that it's live music's biggest years yet, and at least for the full year of 2024, they did post revenue of $19 billion. They said it was a record for full year revenue, and that was up 2%. They also said that arena and amphitheater activity drove fan count to 151 million. Concert attendance up 4% year over year. So overall, maybe a big sign of a macroeconomic signal that people are going out, they're attending concerts, and they're buying those concert tickets. But Alex, what are you looking at?
Hey, Emily, I'm taking a look at Block. That is the company best known for the payments service Square, and also for its peer-to-peer payment platform Cash App. Safe to say a big swing and miss here with earnings. You can see the stock taking it on the chin here in after hours, trading down about 7% right now. It missed across the board on revenue. Transaction-based revenue coming in a tad below estimates, $1.68 billion versus $1.7 million. Also missing on the Cash App revenue, Square segment, and most importantly, that Bitcoin revenue coming in at $2.43 billion versus an estimate of $2.63 billion. Of course, that was a big source of optimism among analysts amid the resurgence in Bitcoin. And Block has been having a bit of a difficult year. It's down about 2% this year so far, and about 7% in the last 3 months. Still, despite recent weakness, analysts seem to be quite bullish on the stock. It's got 37 buy ratings and just 8 holds and 4 sells. RBC in particular highlighted the revival of Bitcoin being a really strong narrative here for Block. They do report their earnings at 5 p.m. Eastern time. We're expected to hear more on crypto. Natalia?
I'm watching shares of Booking.com. They are currently up by almost 5%. Really strong earnings results. The company beat expectations on EPS. All key metrics such as airline tickets, gross bookings, room nights sold came above expectations. There was a slight miss, however, in rental cars sold. But overall, guys, it all goes in line with reports that we saw from Airbnb and Expedia. It supports bullish case for the global travel sector. However, we know that Airbnb and Expedia posted slightly disappointing guidance. So Booking.com will talk about its guidance on the earnings call, which starts less than 5 minutes from now. And some analysts are already saying that the company may face headwinds from currency fluctuations.
All right, our thanks there to Emily, Alex, and Natalia. A couple other earnings we're keeping an eye on. BJ's Restaurants rallying hard in the after-hours trade. A beat on several key metrics, but kind of interesting to see the difference between Texas Roadhouse. The shares had been in the red a little bit earlier, Scarlett. Texas Roadhouse actually warning about commodity cost inflation. BJ's didn't make any comment on that, but the Texas Roadhouse raises forecast for how much it's going to have to pay.
Yeah, now seeing 3 to 4% commodity cost inflation versus 2 to 3%. How much of that is going to get passed on to the consumer? Yeah. That's the big question, right? Yeah. All right, let's go now to the top 3, where we name drop the people driving some of the day's most talked about stories. And first up is Brendan Foodie. He is a 21-year-old winner of the Teal Fellowship last year, and he is CEO of AI startup Mercor, which secured a $2 billion valuation after its latest funding round. And what's interesting about this company, aside from the Teal connection, is that it's profitable.
Yeah. Well, good for him. I don't know what you were doing when you were 21.
Not that.
Not that. I'm keeping an eye on Eddie Wu. He's the CEO over at Alibaba, of course, one of the hottest stocks out there right now, saying that the company's primary objective right now is to pursue artificial general intelligence, and it plans to invest heavily in that infrastructure over the next 3 years, exceeding what it has spent over the past decade. And suffice it to say, it's a big part of the reason we've seen a pop in this stock. Yeah, not to mention Ryan Cohen, the news coming out of Wall Street Journal that he's taken an increased stake in Alibaba as well. All right, third on the docket is James Bond, or more specifically, the IP rights to the fictional British spy. Amazon MGM Studios forming a joint venture with movie producers Michael Wilson and Barbara Broccoli that will eventually give Amazon MGM creative control over the Bond franchise. Yeah, this is a big deal. I'm not sure I like it, but it's a big deal because, the Broccoli family has been really had kind of a lock on the creative direction of James Bond film, and that's why you always get these grousing and why they take so many years to come out with a new film. But it's also one of the reasons why you didn't get sort of this Star Warsification of James Bond, where you got all these little TV shows that nobody watches. Amazon? Is that what you're saying? I expect several TV shows spinning off James Bond now that Amazon MGM has the rights to this. I think that's fair. All right. When we come back, we're going to take a look back at this day in history and the shoe squeak heard round the world. Do you remember this, Scarlett? When Zion Williamson was knocked out of his Nikes live on national television.
Oh, this was ugly.
This is Bloomberg. All right, let's take a look back at this day in history. Back in 2019, when Duke University's Zion Williamson stepped onto the court against the North Carolina Tar Heels in one of the most anticipated matchups of the college basketball season. The sold-out crowd at Duke's Cameron Indoor Stadium included Barack Obama, Spike Lee, even Apple CEO Tim Cook. Prime seats topping $2,500 a ticket, all to witness #1 ranked Duke and its 6'7", almost 300-pound freshman sensation, who was the consensus top pick for the NBA draft just 4 months away. But just about 30 seconds into the game, Williamson, dribbling that ball, planted his left foot, and his Nike sneaker gave way, exploding, the sole ripping off, and the shoe flying off into the distance. The home crowd silenced as Williamson exited the game with a knee sprain that threatened to derail his trajectory to an 8-figure professional payday. The timing was also awful for Nike. It was 4 years into a 12-year deal as the exclusive supplier of uniforms for Duke basketball. The idea that a Nike shoe might have ended the career of one of the most promising up-and-comers led to a flurry of internet memes. Nike shares opened lower by 1.5% the next morning, and lawyers opined that Nike could even be held financially liable. Boston Celtics player Terry Rozier, one of the few NBA stars to wear Pumas, rubbed salt in Nike's wound, urging other players to join him over at Puma. But all told, the financial impact on Nike and Williamson was minimal. Nike stock recouped its losses over the next 2 trading sessions, and online orders for Nike products rose in the 3 days after the injury. And for Williamson, he was still picked #1 in June's NBA draft, and by July, he had signed a 7-year, $75 million contract with Nike's Jordan brand, the biggest shoe deal since Nike signed LeBron James for $90 million back in 2003.
All right, I just want to come in here with some breaking news. This is from the energy drink company Celsius. It has turned around in after-hours trading. It was down. It is now higher by 11% after confirming a deal to buy Alani Nu for $1.8 billion in cash and stock. Celsius says it sees this transaction adding to its cash earnings per share in the first full year, and this is after it had reported fourth quarter results. Revenue beat analyst estimates, and it did report a loss for the fourth quarter of 11 cents a share. All right, we were talking earlier about basketball, traveling, obviously not allowed on the court, but it seems to be happening everywhere else.
Well, if you're LeBron James. Yeah.
Does he travel?
Yes, all the time.
Okay, all right. Well, anyway, for the rest of us, it's not allowed. But when you look at travel trends and you look at what happens with Booking Holdings right now, up about 4% in the after-hours trade. And this is after its revenue did beat analyst estimates, and for the most part should have been pretty positive. Fourth quarter revenue topping estimates, and travel airplane tickets, in fact, went up some 50-something% in the quarter. On the other hand, you had TripAdvisor tumbling almost 7% on the day after posting a disappointing revenue forecast for this quarter. So here now to help us make sense of all of this is Brian Kelly. He is the founder of The Points Guy. He's the CEO of The Points Guy. Brian, during the pandemic, obviously, travel ground to a halt. After the pandemic, there was this big revenge travel. Everything popped. Have we reached normalization? Are we back to what we should be?
Well, we're beating pre-pandemic numbers in a lot of different metrics, especially TSA this year or last year. Several times we surpassed 3 million passengers, and those numbers continue to rise. I see the temporary blip in earnings now, I think, are just a little blip. Everything we see in the travel industry is consumers are spending on personal travel. They're now going further than ever before this year. We were just talking, Thailand and Asia, which wasn't so big the last couple of years, but now people are expanding beyond Europe and people are traveling longer. So I think in general, the travel industry is going to continue to rise. And the only thing holding the airlines back is just getting new aircraft. Boeing and Airbus are just so delayed, but they're trying to increase revenue every chance they can get, including with fees. That's how they're trying to squeeze as much out of each passenger, which it's not great for passengers.
Right, and making the flying that much less fun. I was going to say more miserable, but let's just go with less
in the back
fun.
of the plane. Now, in the front of the plane, it's a different story.
And the
business class, lie
really
flat beds, individual suites. So, things can be really good in the front of the plane, but it is getting more expensive.
So how are companies?
I don't go past the fifth row.
You guys, I'm always sitting in economy. I don't know what you guys are doing, what I'm doing
I'm
wrong.
6'7". It is medically a necessity for me to sit up front.
I'm 5'3". I'm always in the back row, so like the final row of economy. Let's talk about what credit card companies are doing in terms of rewards and points to kind of cater to this new love of travel or this new level of travel that everyone is demanding.
Yeah, so I mean, the credit card companies are doing extraordinarily well. We are living in a points-obsessed economy. The credit card companies continue to add on perks. One of the biggest areas we've seen is in the lounges. There have been so many Amex Platinum card holders at their Centurion lounges, in some airports have lines. So the airlines, including Delta, had a big reckoning last year. And actually, just this February 1st now, you need to spend up to $75,000 to get unlimited visits.
Yeah.
So they're trying to cull the herd because if everyone's VIP, is anyone VIP?
Yeah, and we saw that. I mean, I was an Amex card holder, and I saw just the evolution of that for the worse because it just got so crowded in those lounges. But then you have a Chase Lounge that opened here in New York.
Beautiful lounge.
Beautiful.
Stunning.
Oh,
it's opening now in Philadelphia as well. So
my God.
Capital One lounges are great as well.
That's worth the $650 a year or whatever the heck I'm paying for that card. But to that point, though, I am curious about the airport experience because we've seen airports upgrade, certain ones upgrade at least, trying to make that travel experience less miserable before you even get on the plane here. So for travelers that are trying to, I guess, game the system, if you will, do they go for a standalone credit card? Do they go for a mileage card directly from, say, a United, Delta, American? Like, what's best?
Yeah, in my opinion, the transferable points credit cards are the best. The individual airlines, this is big business. Most airlines are making more money selling miles to credit card companies than flying airplanes. But the problem is they're in control of their currency. So, Delta, great airline, but they've been increasing the amount of miles needed. So I recommend consumers get those Amex Gold cards, which is 4X on all dining and groceries, or that Chase Sapphire, because you can get into their beautiful lounges, plus earn really flexible points that you can transfer to a ton of partners. When you bank with just one airline, say you want to splurge and take Emirates to Dubai, if you have United miles, you can't do that. Yeah. So having Amex, Chase, Bilt points, if you pay rent, that's a no-brainer.
I was just in that Chase Lounge last week.
So I know. It changed your life, didn't it?
Nice little beet salad and and some wine, which they deliver to you. It's not like a buffet where you have to just scrounge with the
service.
Riff-raff.
Yeah, so I guess the question that I have when it comes to travel is what's going to be the new innovation that is going to come from the airlines? Because, if you're in the front of the plane, it's great. If you're in the back of the plane, it's kind of terrible. And as you mentioned, there aren't enough planes for the airlines to meet demand. And, if there's further consolidation, I'm curious how that changes the offerings.
Yeah, well, I think the biggest elephant in the room right now is all the consolidation. Spirit just announced they're going to be allowed to survive bankruptcy, but they're going to go private. And even Spirit Airlines, which is known for no frills, is going to start catering to premium passengers.
Really?
That's the
How do they do that?
Well, they're going to start offering alcohol. They actually have a bigger seat, which can be a great deal. It's like a first-class seat. But the bottom line is to make money in airlines these days, you have to be squeezing premium revenue, and you need to be squeezing loyalty out of consumers. Yeah. So Spirit's got to get their act together. Their loyalty program's horrible. They don't make really any money from their credit card. But points, I call this the platinum age of travel, where people, everyday consumers, you can fly in the front of the plane if you play your points correctly. And now there are tons of tools out there because a lot of people have points and don't know how to use them. But there are tools like point.me, which will actually tell you which airline to transfer that has availability on the days you want to travel. So the points game still can be played, but you need to use technology to stay ahead of the curve.
You should write a book on this. He wrote a book on this.
He did write a book. He also had 2 kids.
What is it? How to Win at Travel?
How to Win at Travel, yes, which teaches, so much as travel is change, and it'll teach you everything you need to know.
So a 2-year-old, a 2-month-old, and a new book.
And a new book, yeah. So I'm going to Thailand on vacation soon,
you are going. Okay.
And sleeping.
All right, Brian Kelly, founder of The Points Guy. Really appreciate your joining us. Thank you so much.
Thanks for having me.
All right, we have some breaking news, Romaine. Kathy Hochul, the governor of New York, says she does not plan to remove New York City Mayor Eric Adams for now.
All right, you can see Hochul having the press conference here. You can watch that in full on Live Go on your Bloomberg terminal. But we do want to go back to our discussion about travel. While if you're hitting the air, maybe there is a lot there. We saw a big downdraft today in some of the cruise line stocks. This apparently after some comments that the Commerce Secretary of the U.S., Howard Lutnick, made on Fox News, suggesting that cruise operators could start paying taxes under the External Revenue Service program with the Trump administration. James Hardiman joins us right now, a director at Citi Research covering U.S. leisure and travel. And James, let's just first start off with the structure, because a lot of people don't necessarily know this, but when you get on a U.S. ship or a U.S. ship that's owned by a U.S. company, a lot of times it's flagged in a country that is not the U.S., which apparently allows a little bit more flexibility in what types of taxes these cruise line operators pay.
Yeah, that's 100% right. So all the major cruise companies, while they're domiciled or headquartered in the United States, mainly Florida, they're incorporated in other countries. So think Panama, the Bahamas, Liberia, and Switzerland. And so for the purposes of the U.S. tax code, these are foreign shipping companies that are doing business in the United States and therefore exempt from federal income taxes. That is the, if you want to call it a loophole, that the Trump administration is at least, in the early stages of discussing closing.
What's the likelihood, though? And I know this is just kind of one comment made by the Commerce Secretary, but how realistic is the possibility that this becomes a reality? And if so, what would the impact, the financial impact, be on the companies?
Yeah, I mean, I think the likelihood is low, and I say that just based on the dozen or so times that I've seen this issue come up over the last decade. And we can talk about why it would be difficult to pass something like that. But I think whenever the current president and certainly the Trump administration talks about these types of things, you can't really count it out, right? Because I think there's a willingness to do things in different ways that maybe previous administrations have not been willing to do. So I don't want to say this is a complete red herring. But if history is any indication, it's not exceedingly likely. And the reason for that is, as we talked about, these companies are headquartered elsewhere. And so if we say that all companies that are, they're headquartered here, but they're incorporated elsewhere. And so if we say that all companies that are headquartered in the United States need to pay federal income taxes, well, as a cruise company, you can just up and leave, right? And ultimately be headquartered elsewhere and avoid that. And the implications to those states that are employing, significant cruise workers would be negative, and you still wouldn't get them to pay any taxes. I guess the other way to go about this is to say, for the time spent within U.S. ports, we're going to tax these ships. Problem there is that most of these cruise ships don't spend a ton of time in U.S. ports.
Yeah.
They spend the majority of their time either in international waters or in other countries.
So right now they don't pay taxes. Howard Lutnick is suggesting that they will pay taxes. What about something in between? Do you see room for a compromise where they perhaps pay some taxes, but they don't become full-fledged companies that pay U.S. income tax, U.S. corporate taxes?
Yeah, it's a great question, right? And so if we know anything about our current president, it's that he wants to make a deal. And so I think the biggest risk here is headline risk. And so even though it might be difficult to force them to pay taxes, maybe there's a deal to be made that will make this go away. I guess the problem with that is historically the cruise industry has very much seen that as a slippery slope. And certainly a path that they would, all else equal, not like to go down. Now, maybe these are different times and the president can make things uncomfortable enough that they would be willing to make a deal. But that's certainly not choice number one here.
So, James, out of the companies that you cover in your universe, which one is best positioned going forward if this is unlikely to become a reality in the near term?
Yeah, I mean, I've said for a long time that Royal Caribbean is best in breed. For the cruise industry. They're arguably, the best company that I cover. They have the best assets for sure. They have the best balance sheet. And I would argue they probably have the best management team. So sort of long term, I think they're your best bet. Short term, there's a lot of different ways to play sort of near term trends. And certainly as we think about 2025 is going to be a big deleverage year for a company like Carnival, which is one of our other favorites. But over the longer term, I think Royal Caribbean is the way to go.
All right, James Hardiman, really appreciate your joining us, a director at Citi Research covering the U.S. leisure and travel sector. Let's just recap what happened in markets today. I know there's been a flood of earnings, but on the day, it was pretty much risk off when it came to equities remain. The S&P didn't close at its lows, but down 0.4%, didn't rally into the close like yesterday either. So retreating from a record high. Also, the Russell 2000 closed lower. The NASDAQ also closed lower. So, most sectors closed in the red.
Yeah, you saw a rotation into some of the more defensive pockets of the equity market. Then, of course, you also saw a little bit of nibbling in the Treasury market as yields dropped on the benchmark 10-year for a second straight day.
This is The Close on Bloomberg.
Everything that President Trump's administration is doing will be disinflationary. We're going to bring down energy costs. We're going to bring down regulation. What DOGE is doing in terms of cost cutting. And I think once the Tax Cuts and Job Act is made permanent, then we can have a revenue increase, cost decrease. And as you said, as the nation's top bond salesman, I got a pretty good story.
That was U.S. Treasury Secretary Scott Bessent on Bloomberg Surveillance today, talking about the Trump administration's goals to bring down inflation, of course, also reduce spending and grow the economy. Joining us now to discuss what's going on in Washington is Erik Wasson. He's a congressional reporter for Bloomberg News. Erik, Bessent and the other cabinet officials have been very consistent about their goals. What's the latest on the Congress front in terms of how they're moving forward with really basic things like sorting out the budget?
Well, first of all, I would take a little bit of issue with what he said about everything the Trump administration is doing is disinflationary. They are proposing large tariff increases, which would tend to increase prices. But as far as the Congress is concerned, there are major attempts here to enact President Trump's top legislative priority, which is tax cuts, which is extending the 2017 tax cuts. The House has a $4.5 trillion runway to extend tax cuts, which would add $3 trillion over 10 years to the deficit. This is far larger than any of the cuts that the DOGE group is actually realistically looking at. We had good analysis on the Bloomberg terminal where they've really racked up probably about $8 billion in actual, canceled contracts and other savings. So there's a lot of talk about sending $5,000 checks to everybody that the president's considering, which I would argue would perhaps also spur inflation. But there's just really not that much DOGE savings. And in fact, we just saw the Speaker of the House sort of throwing cold water on that at the Conservative Political Action Conference.
Yeah.
The Senate is today taking votes on a separate budget. They think that the tax cuts and the debt ceiling issue should be shelved for later. And they're just trying to add about $300 billion in spending for the military and border enforcement, which is something the president ran on. So there's a lot going on in Congress, but really we're tending to see increased deficits, increased tax cuts.
Yeah.
There is talk of cutting social programs like Medicaid and food stamps, but the party's deeply divided on that, with moderates talking to us saying that they don't think that plays well with voters. So there's certainly a large chance that large tax cuts get enacted and spending cuts don't really come following through.
So I am curious here, Erik, about the process here. I mean, if Trump is basically saying, okay, let's go with the big, beautiful bill that the House produces rather than what the Senate was trying to do, this still has to play out tonight. And Democrats have made it clear that they're going to at least try to be a bit of a fly in the ointment. I am curious, if the House comes back, I think it's next week when they come back, and they do pass that big bill, does this then have to go through the Senate for a full 60 votes, or does this go through a reconciliation process where they would only need the 50 that they already have in the majority in the Senate right now?
Yeah, all of this, as long as it, sticks to budget rules, would only require a simple majority. They would have to then go back and repass the House budget or a compromise budget, which is more likely. Senate Republicans have made clear they want to make the tax cuts permanent. There's even talk of, eliminating the estate tax, a lot of other goodies in there. And this $4.5 trillion limit that they're talking about in the House, which was made in order to satisfy the fiscal conservatives, is probably not enough. Probably needs at least $1 trillion more, maybe as much as $10 $10 trillion by some estimates. So there's probably going to be a compromise there. The Senate also wants to use something which is kind of a budget gimmick, just to consider all the Trump tax cuts, extending them to cost $0, which I could also see them doing if they really can't come up with spending cuts that they can agree on. So it's going to be a bit of a process. The vice president says this could all get enacted by June. The speaker said by Easter. My money's probably by the August recess.
All right, Erik Wasson there down in Washington. A closer look here at the budget process, which ostensibly really starts to get underway tonight with some votes in the Senate when the House returns. Of course, they're also going to have to try to move this big, beautiful bill that Trump seems to be more in favor of. But the big question is sort of what gets cut. We know $4.5 trillion in tax cuts. They want to extend those here. What do you cut to offset that?
This is going to be a really interesting process and probably pretty much in fits and starts all the way through. I wonder to what extent corporate lobbyists are really lobbying Congress versus just going straight to the White House at this point. Yeah, I don't know. That's a big question here. Of course, we'll have full coverage of that as that plays out over tonight and into tomorrow. But stick with us. We're going to set you up for some of the other potential market moving events over the next 24 hours. This is Bloomberg. All right, let's push ahead to what the markets will have their eye on over the next 24 hours. And we're actually going to start in the world of sports, the Four Nations final being played later tonight. Yeah, and this is going to be in Boston, so I'm curious to see whether Americans are going to boo during the Canadian national anthem the way the Canadians did for the U.S. national anthem on Saturday. All right, well, we'll go back to the markets here. Tomorrow morning, 9:45 a.m., we get those S&P Global PMIs, and we are expecting, at least economists are expecting, a bit of a rebound in some of those numbers, which have been soft in past readings. Right, they're all three, with the services, manufacturing, and the composite all expected to show growth, numbers above 50. We're also going to get a read on consumer sentiment tomorrow at 10 a.m. Yeah, and the interesting part of the Michigan Consumer Confidence Index is really what people think about inflation. Right now, they're expecting 4.3% inflation over 1 year and 3.3% in 5 to 10 years. Yeah, and that's going to be a big read. I mean, keep in mind, next week we go into a lot of those earnings out of retail companies, so it'll be interesting to see what the read is on consumer spending. And your favorite, Scarlett, Fed Speak. Vice Chair Philip Jefferson, who will boo him? No one's going to boo him, Vice Chair. All right, that does it for us here on The Close. We'll be back tomorrow with all your market-moving coverage. Balance of Power is up next.